We are Acorn Capital. Creative, agile, experts, responsive, flexible, reasonable, reliable specialists in commercial real estate debt. And we do what we say we'll do. We provide a single seamless process in a one-stop shop, certainty of execution, and expertise refined over decades.
Well, good morning, everybody. A lot of familiar faces on that video we just saw there. My name is Kathy Cunningham. I'm the finance editor and co-deputy editor of Commercial Observer. It's my pleasure to welcome you to today's power briefing. I'm joined by Warren DeHaan and Chris Tokarski, two co-CEOs and also two of the four co-founders of Acorn Capital. Hi, Warren. Hi, Chris.
Hi, how are you?
Good. How are you doing today?
Good. You got me up early, so.
I know. Apologies for that. Hopefully it'll be worth it. Hi, Warren.
Hi, Kathy. I'm having technical difficulty, but I'll get through.
Okay. Where are you in the world? Are you both in California today, or where are you today?
I'm in just north of San Francisco.
Okay. How about you, Warren?
I'm in Los Angeles.
Very nice. Very nice. Great to see you as always. So before we get started, anybody watching that has questions for either Chris or Warren, please do submit them via the Q&A button at the bottom of your screen. We'll get to as many as possible. We already have a few actually come in, so I'll address them later in the program. So maybe to kick off with the big picture, guys. So this is the global picture, this is the title of this webinar, but I'd love to know what you're seeing today. We're 20 months into the pandemic now. What are you seeing in the market from a debt and equity perspective? Are you seeing a lot of activity, or how would you describe what you're seeing today?
Well, I'll jump in here as I'm dealing with some technical difficulty. I apologize.
No problem.
Look, I think the markets are very healthy right now, by and large. I think that a bunch of this is driven by the fact that, there is this need for global, there's so much liquidity in the global system, whether it's here in the US or foreign capital, by way of example. You could look at the fact that there's somewhere around $14 trillion of sovereign debt that's yielding less than zero. You can look at the banking system, the total deposits rates, effectively the loans to total deposits drives a lot of need for the banks to invest in loans and deploy their money. I think we're at $18 trillion in deposits versus 14 trillion, a couple of years ago.
Right.
In terms of dry powder on the private equity side, there's about $360 billion of dry powder looking to make investments in commercial real estate. And that's just in the sort of private equity side. And then we have this emergence of the non-traded REITs too, folks like BREIT that have done an amazing job of raising capital through the retail channels. And I think they have somewhere in excess of $40 billion of buying capacity this year. That not to mention the pension funds that need to hit yields, and in the pension funds they've grown their asset bases quite healthily over the last year as the markets have increased. So what we have is the denominator factor, meaning that the total dollar amount of investable assets in the pension fund industry continues to grow. And certainly, while the allocation as a percentage might stay the same to commercial real estate, the absolute dollars increase. And then you also have, the insurance company industry that has about 7 trillion in assets, of which, pick your number, some percentage is going to go towards commercial real estate, whether it's mortgage-related product or equity-related products. That's going to continue to drive, pricing. So whether it's on the debt side, you have this certainly increased regulation around the banking industry, which is pushing more money into businesses like Acorn, and the need for people to generate yield, and we, among our competitors and friends, generate a very interesting product for all of these constituents. So whether it's on the debt side, and in the debt side too, you can take a look at the CMBS market, the SASB market, very healthy levels of demand for those bonds, already driven by this need for yield globally, through the debt markets, and absolutely into the equity markets. So from our perspective, as we look at it today, there's a tremendous amount of global liquidity. I mean, also in the US, you might take a look at the sort of weakening of the dollar over the last year or year and a half. And so what the dollar does is it drives more interest in the US because US assets become cheaper. The US has always been a safe haven for money. And the hedging costs fundamentally have come down for foreign investors. So what we are seeing is we're already seeing this need for yield, this need for CRE product, and this belief, certainly, one other point I'll make, that commercial real estate is a great inflation-adjusted investment vehicle for a few reasons. One, certainly, as replacement costs continue to increase, an ability to buy below replacement cost is a sound investment thesis generally. And secondly, as inflation kicks in, you'll see, rising, whether it's at hotels, rising RevPARs, and you should see rising, rental rates among the other asset classes too. So generally, we view the market as healthy, but there are certain things on the horizon that could be somewhat problematic, but we can talk about those in a bit.
Sure. Now, Warren, you mentioned the safe haven element. So that's one of my questions, actually. Do you think the US has hung on to its safe haven title throughout this crisis?
Yeah, I do. I mean, I think, when there's global unrest, as has happened over, and continues to happen, the US has always been a safe haven. And, not only do we have a great rule of law here in the US, it's more easy to underwrite US-based asset than it is to underwrite assets, in certain foreign and emerging markets. And I think the other point is there's great liquidity in the US market. So, we have a very well-established investment sales brokerage community. We have a tremendous amount of liquidity that's looking to acquire these assets. And so what it means that if there's a foreign investor that's looking to exit an investment, there's a well-understood mechanism for them to exit their investments without taking existential risk.
Got it. Chris, anything to add there?
No, Warren had us. I think he's got us covered. It's there's lots of money flowing into the space, and I think it's going to continue. So I think we're pretty healthy. I guess the one thing I would add is when you layer inflation onto this, really, and look at the basis just becomes more attractive every day with the inflation that's happening. So I think that's really what's driving everybody in there. But there's way too. It feels like there's too many people chasing the same deals.
Now, earlier in the crisis, I should say, we saw a lot of foreign capital flowing to secondary markets as opposed to some of them who would historically have gone to primary markets and trophy assets and what have you. What are you seeing from that perspective in terms of where the foreign capital is flowing today? Is it to the main markets like New York, LA, what have you, or is it secondary markets that perhaps they haven't been in historically?
I mean, the secondary markets have become more attractive to investors, broadly speaking.
Right.
I think it's, there's a few reasons, right? I mean, in some of our primary markets, there has been some nervousness from the investment community around certainly the work from home patterns that are starting to develop. If you look at states like New York and California, New Jersey, they have been tough from a tax perspective, and what that's generally done is it's started to drive some, and actually a lot of companies out of those states and into the migration markets like Texas and Tennessee and other tax-free states, Florida. And so there from our perspective, we review 300 billion in deals a year. We're seeing more and more inquiry for folks that historically were investing in the top 7 markets in the United States, moving into these secondary markets and taking the bet that these migration patterns are persistent and are here to stay.
Interesting.
So the secondary, and the other part of this is there is a strong belief among quite a lot of people that there is going to be a difference in behavior in the office sector, where folks or companies that had their headquarters in places like Manhattan are now saying we're going to shrink our headquarters to something way smaller in Manhattan, and we're going to move our headquarters to Florida or somewhere like that. That is more forgiving from a tax perspective, lower cost of living, and generally speaking, an easier lifestyle for employees. So we are seeing that, and we are seeing investment sales and flows of capital move into those markets quite rapidly.
Well, interesting. We'll get to the question of work from home and office later in the discussion also. But I'm curious today, when you're in the market looking at a deal, who are you competing against? Is it the banks? Is it other debt funds? Or how do you describe the composition of your competitors for each deal?
I think I would say it's really deal by deal. You know, we kind of, our loans start at 30 million and go up to several hundred million. And so I think I break lenders into some, you know, some lenders are chasing deals that are, you know, sub 30 million. Maybe they pop up to 35 or 40. Some are in the 30 to 100, and then others are above 100, and then some are above 200. So it really varies. We also do all property types. So, you know, some lenders are staying away from hotels or staying away from construction. So it's, you know, given that we really look at everything from pre-development loans through stabilized assets, and we do all property types, it really, and do sizes from 30 to several hundred. It really depends on the deal. I'd say most often we're seeing, you know, the public REITs and the larger funds, given our loan size starts at 30. Some of the smaller debt funds, we don't bump up against as much, but it really is, you know, I think it's, you know, the mortgage REITs are probably the most consistently there that we see. And then a lot of times our borrowers are looking and evaluating two different lending profiles, meaning they're looking at a low leverage bank only deal, or they're looking at a stretch loan or a loan with a senior lender and a mezz lender combined. And so where we tend to be the most effective is that stretch loan, which a lot of our competitors do, or if a bank is comparing, or if a lender's or borrowers comparing a bank loan with a mezz loan, then we combine the two and just make it easy for the borrower. So I hope that answers your question.
Oh, it does. Yeah, completely. I'm just curious, would you describe the competition today in the market as kind of similar to 2019? Are we not there yet? Or how would you describe the competition today?
I think if it's a multifamily or industrial asset, it's as heavy as it's ever been.
Right.
You know, for the rest of the product, it probably feels, I guess, about like 19. You know, it's harder to underwrite assets today, right? It's a little bit more challenging.
Sure.
So I think everyone's piled into the assets that are easy. And, you know, we try to generate a little bit extra yield. That's what we get paid for. We're not a bank. And so, you know, we're trying to find those deals that are a little bit unique, where other lenders may not be as attracted, or there may be a unique, you know, something that requires a little bit more work to get comfortable with what's going on. And that's really what we try to do, is provide provide liquidity to assets that have a little bit more unique situation, so that there's a little bit more yield in them. So it's harder today than it was in 19 to find deals, but mostly that's because there's product that's harder to underwrite and figure out.
Right. So by unique, do you mean hairy, or?
You know, I would call Warren hairy and not deals. Or he might call me hairy, but yeah, I'd say hairy. We need a little bit of hair, somewhere between a little and a lot, is kind of what we specialize in.
And not to dwell on follicles or hair, but you know, what would you describe as a typical kind of, you know, hairy deal for ACOR?
No, Warren, you want to take that, or you want me to give it a shot? I'm going to describe a gorilla. I like gorillas.
Confused with the hairiness.
Yeah, I've been known to try to chase the gorilla. You know, hairy comes at different levels, whether the building and the operations of it are hairy, the sponsor's hairy, you know, the capital structure's hairy. So, you know, hairy includes tax credits, EB-5,
right,
multiple levels of equity on an asset that's going through transition. That's, you know, on any given day, maybe we should throw in some an opportunity zone as well.
Various levels of hairy. So for those deals that are a little bit on the hairier side or unique side, you're not seeing the same competition, because from our reporting, you know, it seems like everybody and their mother is trying to get into multifamily lending right now. So for the more unique deals, you're not seeing the same kind of competition. Is that correct?
Yeah, I mean, I think that the reality is the harder the story is, the more you have to work, the less competition there is, right? There's a lot of people that'll line up for the straight down the middle multifamily that's easy. And you know, our less hairy deals tend to be from customers where we have done business and we have documents done, and they know our process, they know our people, and they know that if they show up, we'll get it done quickly and efficiently. And if we have to go compete in a competitive market to do that loan, there's too many people chasing it, and it's not worth the time and effort. Where if there's a new deal and that's in the market and we're chasing it, we try to find stuff where it makes sense for us to invest the time to underwrite it, get to know the situation, the sponsor, and the deal. And so there's got to be some wrinkle that is going to make other lenders not want to do the work.
Got it. Now, just broadly speaking, so Acorn Capital was founded in 2015. So this is your first crisis as the company, although you've both obviously been through several crises in the past. So any big takeaways, first of all, from this crisis? And also, how did your portfolio fare during COVID-19 so far?
Portfolio has fared very well. We have, going into the crisis, we had about 225 loans, a little over $15 billion in position. We had a total of 3 foreclosures. So, I think, what we try to strive at Acorn is we're not a loan to own. We don't want your asset. We've made 250, nearly 250 loans at this point. So that's, and in the worst times, that's our total foreclosure. We've never foreclosed on anything else. So, it's not, in all of those situations, we believe we'll get all of our principal and interest back. One of them has been fully resolved and we got all our money back. And the other 2, we think we'll it's pretty clear we'll get all our money back. So right. I would say the portfolio has performed extremely well. We'll get through this with 0 losses. And so I think it couldn't be better. It hasn't been easy. We've had to roll up the sleeves, and we've worked with a lot of borrowers, and we have a 30-person asset management team. And so that team, and during the crisis, we had all of our originators and credit folks, plus the asset management team, working with all of our borrowers to try to come to, amicable resolution and work with them to, get to the other side of the tunnel. And, we feel like we're there. And, we tried to be responsive and respectful and thoughtful in our approach in dealing with each of the borrowers and trying to get to the other side. And, we've gotten there. The portfolio's held up, and, luckily we've done very well.
That's excellent.
I'll add, Kathy, a couple of things from a proactive perspective.
Yep.
That were interesting. I think that when you do have the crisis like we went through in the pandemic, it really does test the infrastructure that one builds in a company. And, in the early days, when we started Acorn, we invested heavily in our asset management team and in technology. And that stood us in good stead going through the crisis, because as you can imagine, every investor wanted to know in real time what was happening with the portfolio, as they were either marking their positions or they were, evaluating their positions internally and had their constituents to report to. So that was very valuable. But what was also valuable was, given the scale of the company we have, we recognized that there were some real opportunities. And one of the things that Chris and I really like to do is, when there are pockets of illiquidity, we believe, and not really a credit issue, but a liquidity issue, that's a great time for you to be a lender. And so we did a couple of things. One is we went heavy into multifamily at a time when there was still a decent degree of hesitancy in the market, and even the REITs on the multifamily side were trading down 30% or something like that from their highs. There's just general nervousness and overreaction to the downside on pretty much everything. So we jumped in there and were able to do a couple of $2 billion of multifamily pre-agency and construction loans that we think were incredibly attractively priced relative to pre-pandemic. We were also able to do a bunch of industrial, which we weren't able to do pre-pandemic.
Excellent.
And then we formed Acorn Hospitality Partners, which is a high yield vehicle to provide recovery capital to the hospitality industry. So really high yield, so mezzanine and preferred equity capital to the hospitality industry, because really in the hotel industry, a lot of our borrowers and friends of ours in the industry, bank accounts were basically empty. They were making operating, the hotels were closed, they were making operating expenses out of pocket, they were making debt service out of pocket, and fundamentally needed some liquidity to get them to the other side. So that turned out to be those were 2 very good strategic plays that we made coming out of the information that we learned during the pandemic.
Absolutely. Now, the hospitality fund, $1 billion fund, you've done 1 transaction out of that so far. Is that correct?
We've done one which was large, and then we have a few on deck right now. I think that's an interesting space because it bounced back so quickly, or at least the optimism came into the system. I mean, if one looks at the public markets and see where they're trading right now versus where they were trading pre-pandemic, you'll see that there's a lot of optimism around the recovery. So where there's optimism, there is a will to get through it, and there was less of a need for the bridge capital than, let's say, March, April, May, June of last year. However, there's a couple of, I think, interesting opportunities ahead for that vehicle. I think one is the part of the sector that is less spoken about, but is a big problem, is that many hoteliers have not funded capital accounts or capital reserves to account for CapEx issues brought on, over the last couple of years. So there's going to be a big need for CapEx in the industry. I think secondly, the Delta variant, while it looks like it could be short-lived, will also create some liquidity problems for some borrowers. I think the third sector that is of real concern, broadly speaking, is will business travel come back? And if so, what form will it come back in? And that, I would say, in the hospitality sector is a giant topic of discussion. I also think there's one more point there that I would add, is that we expect to see rotation in the high yield investors in a lot of these capital structures. In other words, because it's been, really the deals have been delayed through the pandemic, the sponsors either have no promote left, or secondly, their high yield investors want to get out because they've been in deals longer than they wanted to be in. So I think we can expect to see some rotation in the high yield investor space. So all those things would lead me to believe that we have a decent opportunity set going forward to invest capital. And one of the things that we sort of differentiate ourselves in is that we are not equity folks. We are debt. We are debt oriented. It's all we do. And ACOR is a trusted lender. So when we get calls from a number of our borrowers or friends in the industry, they know that we're a friendly face. We don't want to own their properties. We don't want to foreclose on them. But we're just looking to get paid that high yield rate, as well as have a seat at the table if something goes wrong.
Absolutely. And in terms of the hospitality fund, what was the investor appetite like for that? I guess there's been a lot of interest in any kind of distress or rescue capital kind of scenario in the industry. So when you first launched this fund, what was the reception like?
It was incredible. I mean, we have a large hotel portfolio at ACOR that has performed well, and we were, call it lucky or smart, that we were good at picking our sponsors and markets. And so
I was lucky and Warren was smart, by the way. Just...
I'm hairy and he is not.
So I am. So don't tell me.
So I mean, it was incredible because many folks had raised funds to invest in quote unquote distress, and those funds came out fast and furious, and there was an expectation of not just illiquidity but also a credit crisis. And I think when you boil it down, I think that we faced a liquidity problem, meaning that the industry faced a liquidity problem, which creates opportunity for high yield investors. And I think prospectively, we need to stand by and watch and see what happens, particularly in the office sector, as to whether or not these changes in behavior associated with pandemic and work from home result in more of a credit-related issue in certain markets and in certain sectors. But I think that's, it could be a year or two off before we start to see that happen.
Right. And in terms of the potential opportunities that are coming your way for the hospitality fund to address, what are you seeing today now that we're 20 months into the pandemic?
There's so much liquidity in the system, broadly speaking, that anything that has a high yield on it becomes extremely attractive to the investor base. And what's interesting about the investor base is, we traditionally saw private equity funds in real estate as the dominant sort of force. Now we're starting to see crossover investors like hedge funds and others looking at the industry and saying it's quote unquote interesting and yields 10 to 15%. And that kind of yield is not available in most other investments in the US. And even on the equity side, you really have to believe to make those kind of investments. So we have seen a compression in yield for mezzanine in the hospitality sector and a greater preponderance of equity capital available to come in and bridge the gap. But, you know, we have a big network. You know, we have over 100 people at Acor, and we're scouring the markets every day and have tremendous equity base or base of borrowers. So we get to get good looks at these opportunities. But it has, you know, certainly it's been slower in that vehicle.
Right. Now, you know, through the crisis, I think there are so many people that are not anticipating distress. That sounds a bad thing to say, but you know, they're hopeful to be some opportunities in the distress kind of realm of our industry that never really materialized. I mean, even myself as a reporter got calls from people saying, "Are you hearing of anybody who is in trouble?" or, you know, what have you. It's kind of a horrible thing to say in the middle of a global pandemic. But from your perspective, why do we never see, you know, any kind of material level of distress during this crisis?
It's the government. I mean, the government, as taxpayers, we should, you know, we're all paying for the reason we didn't see the distress. It's going to come out. The government sprayed money. It was a fire hose that was just, you know, I think, you know, we can go on and on and on about where there's waste, but it shows up. All you have to do is look at anyone that's trying to hire someone. The fact that you can't hire anybody anymore. There's no labor. There's no labor. You can't get an Uber. You know, we went from being able to get an Uber in 2 to 5 minutes to 20-minute cancellations. You know, so I think at the end of the day, it's really, really clear that the government spread money, you know, at everyone. I think some of it was, in hindsight, probably smart, and others just wasteful, and we're going to be paying for it for a while, and we're going to get inflation. You know, the inflation's way higher than anyone, you know, I shouldn't say anyone, way higher than the government is telling us it is. And I don't know whether that gets wrung back out of the system at some point, or if it's there permanently. I think that's, you know, what we've got to figure out. But the reason there's no stress is the government money fire hose.
Warren, anything to add there?
I think that's 100% right. I mean, I think Chris brings up an interesting topic, which is really the labor markets. You know, when we talk to our borrowers, particularly those that are labor-intensive businesses like hospitality, senior housing, categories like that. But even notwithstanding those categories, there's a labor problem in the country. And I was at a recent panel where the former Secretary of Labor made a presentation. And one of the interesting facts and questions that comes up is, well, as soon as this stimulus money burns off, you know, that should alleviate the issue in the labor markets. But what he was really helpful in articulating was that this is really a 20-year problem. It's not a episodic problem brought on by the pandemic. It's certainly just exacerbated by what's happened, and we're feeling the pinch of it every day. But, you know, our labor participation rate is awful. I mean, it's around 60% now. So in other words, folks that are actually eligible between the ages 16 and 75 to be in the labor force, 40% of them are choosing not to get a job. It's just perplexing to me as to how these folks, you know, make ends meet or get along, or what's actually going on. But it is a bothersome statistic. I mean, there are other really worrying statistics in and around the number of folks that are just basically the increased rate at which, particularly folks between the age of 16 and 30, are leaving the labor force. And that ultimately folks over 65 are entering the labor force because of, you know, lack of savings or low interest rates, should I say. And secondly is people are living longer. So, but our young population doesn't really want to work. And so what is that knock-on effect? The knock-on effect is that we have roughly 10% of all jobs are unoccupied, meaning that there is a demand for, let's say 100%, and only 90% of people will take the jobs. So when you look at lower paying industries like the hospitality industry or the food service industry, it results in people leaving that workforce rapidly because it's lower paying than most other industries, only followed by the retail industry. But still, maybe 50% of the mean of other industries that are paying like $30+ an hour. So what really does that mean when it comes back to a couple of things? One is actually finding labor to be productive and to be there to clean the rooms, clean the bathrooms, serve you food at restaurants. And secondly, what does it mean from a cost perspective? So we talked about inflation, as a thing, and Chris mentioned, it just doesn't feel like what we're seeing through the Fed is actually indicative of what we're all seeing on a day, in our day-to-day lives. But certainly an expectation that in those sectors, particularly the lower paying sectors, you could see wage rates increase significantly, at 10+% per year, just to compete with other sectors. So I think from a structural perspective, we got a lot to wait and see there over the next 2 to 3 years.
Right, absolutely. And now, in terms of your borrowers, you said that obviously your portfolio has fared really well, but what are you hearing today? Are there borrowers that are still struggling at the moment? Are they still needing modifications, or what are you hearing in general from your borrowers today in your portfolio?
I think we've had the level of modification, I think, is dropped dramatically. Maybe we're working on 1 or 2 mods where we probably had 50 at any point in time during COVID that we were. So I think it's definitely settled down. There's some level of travel. There's some, and really all the heat was in retail and hospitality. So multifamily, we all thought early on that there was going to be a problem, right? I think if you think back to the first couple months of COVID, we were all worried about the apartment buildings, right? People aren't going to pay rent. We're going to have right? And then there's no problem. And now, cap rates went from 5 to 4 to 3 on apartment buildings, and everyone got their rent. And that comes back to the government money fire hose. Because I'm in my office this morning, but it's still 20% occupied. So no one's going to work, but everyone's paying rent. How is this? You can't get an Uber, and Warren's trying to get tequila at the hotel and they won't give it to him because there's no labor. So when you look at all this, it all doesn't solve. The equation isn't, I don't think the math problem's completed, but the answer to your question is there hasn't been any, increase on modifications in the last, it spiked early, came, kind of moderated down, and the last 6 months, it's been super quiet.
Right. Now, just to dwell more on this tequila problem. So is this a international import problem, or what's happening with tequila right now that we should know about?
I'm only human.
But there's none available, or they can't bring it to you, or
no,
it's available until Warren stays at your hotel, and then the next day there's no more left.
I have to actually go and serve myself because there's no labor available. So I become quite good at just climbing over the bar and serving myself. It's a lot cheaper, by the way.
This is good to know. I'm learning so much from this webinar. So
I could be in jail the next time we speak, but I'm happy to speak to you from jail too.
As long as they have, good lighting and webinar set up. That's so now you're obviously in the office today. You mentioned, we've already talked a little bit about return to office, but first of all, are most of your employees back in the office today, and how are you approaching return to work?
Wow, that's probably, I don't think I'm smart enough. Warren better take that one.
We struggled with this. It's amazing because I think we're all in the same boat, right? Which is we have, as 105 people at ACOR, we have 4 offices: New York, San Francisco, LA, and Dallas. And there's not only the idea of how to manage and give people the options to work from home. Is this the new norm versus not? There was also the overlay of COVID and the complexity of folks who are vaccinated versus not. So we certainly wanted to make sure that we were fair across the board, and also fundamentally have a social responsibility to make sure people don't get infected. But as it relates to the work from home policies, we continue to evolve in that regard. I mean, one thing that is very critical for our business is the combustion. We have a lot of that 100 people, call it 20 young folks that are under the age of 25 who are in the analyst associate level, who have never really been in an office. And the problem with that is our business is reliant on combustion. Our business is reliant on listening to each other and saying, hey, I have an idea. Let's talk about this. Let's brainstorm. Get into my office. Let's talk about how we're going to do this. Or it could be, Chris negotiating a deal with somebody, or Kyle or Tony or anybody negotiating a deal with somebody, and having our analyst or associates sit in and listen to that conversation and learn. That's how we learn. I mean, I'm a little bit slow, but it was really helpful for me to learn. by listening to my bosses and other people at the time. So our business is a business of being face to face. It is a business of being around the energy and the information. And there's a lot of hand-to-hand combat that happens in our business, whether it's on the origination side, the credit side, or our asset management functions, which require a lot of transparency and access to what the front of the house is doing. So long-winded way of answering your question, but we're evolving in our policies. We're trying to encourage people to get back to the office, at least call it 4 days a week. We are listening to our employee base as to what their needs really are. But the idea of somebody sitting at home because they want to be at home instead of being in an office is sort of an unacceptable answer unless there's extenuating circumstances.
Got it.
Yeah, I think, Kathy, if you look at this, we're all here on the phone. We've been in this industry for decades. But if you continue to work from home, all of these, how does the progress of your career? Yes, you learn your job, but it's really about relationships, and those relationships are with clients. But our relationships now, Warren and I have been doing this together for a long time. Some percentage of our borrowers are people that we used to work with in the office. And the reason they borrow money from us is because they trust us and they know us and we used to work together. And so this Zoom work from home, everybody get together, that analyst crew between 20 and 30 years old, they just lost 2 years of relationship building, in my mind, in the most important period of their life. This is when you do it. And it takes another 10 or 20 years till you harvest those relationships, but they're not as tight. You're not going to build, because you're on a conference call or a Zoom call with, the people that you're not going to build a tight relationship with them. So I think, anybody that's in the industry long enough and has those relationships already built can work from home forever. But what we really need to do is we want to mix the veterans that have been around and have the relationship and have the knowledge, and you have to create that knowledge transfer that Warren's talking about by being in the office. But then also it's just not healthy for the careers of the younger folks to continue to work from home, because they really need to build the relationships. And I think that's the part that's lost on a lot of people, and it'll have a long-term effect the longer this goes on. They'll progress much more slowly in the long-term career.
Right, 100%. Even from my perspective, I've been covering commercial real estate since 2005, and so I've really worked, the trenches to try and get, the context I have today, the sources I have today, the understanding of the market I have today. So my heart goes out telling me that, entering the industry during this time and having to try and establish a beginning is very, very hard. So what advice would you give to anybody who is in that position where they really have lost 2 years, like you said, or are now trying to catch up?
Go back to the office.
Yeah, that's what I thought.
That's what I mean. If you look at success, it's success doesn't come to people who don't put themselves in the position to be successful, right? It's rare that success is going to find you in your living room at home. So if you want to be successful, build relationships, and do work hard, and that's proven over time to be a way to achieve success. And so I think that we can have some amount of flexibility, and I think that's permanent. That's not going to go away. There is going to be more work from home than there was, but at the end of the day, I think my advice is, you probably have to work harder to make up for those relationships in that time period. And frankly, I've been traveling. I got COVID early. I think the first week I was the case number 9 in Marin County. So I traveled right through COVID, and as what I realized, no one was out there. I was the only idiot at the hotel, I think, at certain cases. Maybe I was one of 3 people in a hotel. But what's happened over probably the last 6 months is probably had some of the more productive meetings, because people have been trapped for so long in their homes that the people that were willing to meet and get out and, whether you had coffee or lunch, a lot of the meetings were not happening in offices, but out, at a coffee shop, lunch, dinner, whatever. Those meetings, they felt special, the early, because it's the first time or the second time or the third time. We all get worn down, right? We have meetings all day long, your attention span goes away. But I found over there was almost a period of first dates where you're really excited because you get to, you're out again, you're talking to people. And I think that some of those early meetings were fantastic and helped accelerate early relationships or just rekindle old ones. But I think it's, we all need to do more of it now to catch up.
Yeah, no,
So
I agree.
Kathy, for those of you who don't know Chris, when Chris got COVID, is the first person on the planet where COVID was actually terrified when he ran into Chris. Instead of Chris getting worried, it was COVID that ran away real quick from Chris. But the other point I would just say is, in order to be successful in our business, you need information, knowledge and information and deal flow. And a lot of that comes through osmosis in the office. So who's doing what? Who's buying what buildings? Why did they buy that building? And having that knowledge separates you from your competitors. And unfortunately, you can gain zero of that knowledge sitting at home.
Yeah, 100% agree. I also feel like we're such a social industry. Also, we're quite a tight-knit, small industry, the finance sector of commercial real estate. So I also really missed just in-person meetings, but I 100% agree with you. Now, more broadly speaking, looking at office. So obviously, the office sector is taking quite a hit. We've seen a flight to quality where, the Class A buildings have received like a lot of new tenants who've been able to upgrade during the crisis. But what's your general take on the office sector today? Are you interested in lending on it, or are you still a little bit kind of skittish around it, or what's your take?
It's the haves and the have-nots at this point. I think we're big picture. I think what's going to happen when it's all over is the better buildings and the better locations are going to outperform, and the lower quality stuff is going to struggle. And so you're going to have more vacancy than we've had, and the vacancy is not going to be spread evenly across all the buildings. It's going to get concentrated in the worst quality product. How much of it's going to be occupied is going to be market by market, industry by industry, and it's going to take time to settle out. And so you've got a couple different. You also have patterns of we talked about earlier, companies moving, and how many companies are going to leave New York. Really, how many are going to stay? We can talk about that, but I don't think anyone really knows. It's going to take time to figure that out. But what we know is there's going to be a flight to quality, so well-located buildings on transportation lines that feel good, right? We're also trying to get people in the office as tenants now. So there was a trend there, and the technology companies started it, which is Google providing food and whatever, everything you wanted as an employee, they would give to you to get you to the office. I think the rest of the world is going to have to focus on that a little bit more. So newer buildings, renovated buildings are going to. And on transportation lines, I think are going to outperform. And then the other thing that I predict, and Warren touched on this, is once we can underwrite office buildings and we start to see what the real rents are and where vacancies are really going to stabilize, I think there's going to be a tremendous amount of trading. Meaning, and why? Well, all the office buildings that are owned in these funds and private equity shops, that once they can underwrite them and they know whether they have a shot at a promote or not, if they have a shot at a promote, they're going to stay in and work it. But there's a lot of buildings, once the dust settles, either because market rental rates are down, vacancies are up, but the ability to get to that NOI that they originally underwrote is not there anymore. There's no more incentive. So now they're just managing a building that doesn't make any sense. And so I think at some point you're going to see an acceleration and a lot of trading in the office space. And I don't. That's probably 6 to 12 months out, but I think that's where we're headed. And it's not one answer; it's market by market, building by building.
Yeah, it's very difficult to kind of make any decisions there. We did a question from the audience there. Any thoughts on the retail sector?
The retail sector has been interesting. And there's a few things that are interesting here. One is that the consumer is flush with cash and feeling wealthy. I mean, just look what happens to people's 401k plans that are sitting in the stock market. They're up like 40% year over year. Secondly, is the amount of stimulus in the system has driven average savings rates to sort of historical high levels or higher levels. And so the consumer is flush, and the consumer has been spending. Rates are low, so having money in the bank doesn't help you. You might as well spend it. So there clearly is this online Amazon effect, but then there are sort of your grocery anchored retail centers and your services businesses that have actually done really well. And then on the other barbell, on the other side, you have the Class A malls, not all of them, but the real Class A malls that have done really, really well. So for us, for our business, look, we have almost no retail in the portfolio, very, very little. But we do believe that there's interesting opportunities to be taking risk in that sector. so the grocery anchored retail centers and those kind of business malls retail centers are generally too small for what we finance unless they come in a portfolio. And if they come in a portfolio, oftentimes they're cash flowing well enough that borrowers are looking for a CMBS market. On the other side of that, you have these giant malls that are getting financed with unsecured debt at 2%, right, for public companies. And then there's a space in the middle, which is very challenging. The space in the middle are these B malls that are turnaround stories that generally look to folks like Acor, companies like Acor to finance them. For Chris and I, we find that those credits are just incredibly difficult to underwrite in that sector.
Right.
So, but having said that, we still believe that there's very interesting segments within retail to finance. And I think you'll see us lean into some of those interesting sectors a little bit more over the next couple of years.
Oh, any clues as to which specific sectors you're looking at?
No, I just say that not all retail is made equal, right? So if you have a center that is, with some of the things we financed are really broken, completely broken malls that are going to be converted to multifamily development. So it's really, a covered land play, and we've done several of those deals. We've done deals like 4th Street Berkeley, which is, service-oriented retail in a market that's really not going anywhere. And it's sort of the primary focus of, traffic patterns in the market. We'll do that. We did a deal in Napa as an example, which, continues to perform extremely well. But, there's a couple of others that we signed up recently that look a little bit more traditional, but are, bought at an incredibly low basis. And also the conversion play is very underwritable from a lender's perspective. So when the baby gets thrown out with the bathwater, it does create opportunities for companies like Acor to step in and make some higher yielding and intelligent investments.
Right. So I guess in those scenarios, you're looking closely at the sponsor, right, in terms of what they can do with that property and how they can turn it around.
I think some is sponsor, but it's actually more if you dig into, as Warren's talking about those deals. It really is the fundamental real estate. When you look at it, it's the real estate was good real estate, and even if most of them are going to be retail, but if they weren't, they can work as something else. And so when you think of the big box retail, when you're driving down the highway and it's on the right and it's on the left and it's on the right and it's on the left, well, you don't know which one's going to work, and when it's done, what do you do with it? But if you take these infill locations where you look at it and say, you know what, this is just good real estate. And over time, you might lose one or two of the tenants in retail, but you can clearly redefine that space either into a service use, which is going to stay retail, or it's likely to get, it's a parcel that can be redeveloped into an apartment building or an office building. But the real estate's so good that it's ultimately going to get used for something. And so where we've stayed away from is if you pull it up on Google Earth and there's still a bunch of land around it, then it's not good it's hard to deal with retail that looks like that if there's nothing around it. One of the things that has evolved, and it's taken time, is most of these cities had zoning and the bureaucracy associated with getting a piece of retail rezoned. But I think all the municipalities it's taken time. They've gotten through where they don't want to see failed, blighted retail either. And so it took a while, but over the last couple of years, it's a lot quicker, and the government side of the business is a lot more responsive, I think, to developers who want to reposition something and make it work. So I think it's really what's COVID and the time, and it's a series of events, but COVID accelerated it. The retail that was going to fail has failed. You can now see it, and the stuff that's left is pretty good. And underlying, there's still some more that's going to fail over time. But the stuff the assets that we're looking for really have fundamental underlying great locations, good real estate, and have a use in the future.
Got it.
Whether it's retail or something else.
A good story to tell. And another question here from the audience: what is your view on seniors housing and/or active adults?
Well, Warren's been looking to move into both recently. He's evaluating where he wants to live for the next 20 years. We've been fairly active in the space, probably more active, frankly, because a lot of people ran away when COVID hit, and I think it's a short-term exit. You got to look market by market. There's definitely too much supply in certain areas, certain submarkets. So you got to look property by property. But overall, that industry is not going away. There's some exodus, some difficulty as a result of COVID, but I think we expect it to come back and stabilize, along the trend line that it was headed before COVID.
Yep.
With the only adjustment being new supply, which you really got to pay attention to, market by market. But it's I'm generally bullish on the space.
Yeah, I'd add one more factor in there. In the senior housing market historically has ebbed and flowed, and the ebb was really as a result of non-senior housing operators and owners getting into the sector and assuming that those businesses were easy to run. And that's where we saw a bunch of either fraud or misconduct or other very poor behavior that resulted from just folks that had no idea what they were doing. This time around, we see much less of that. We see more, smart money, if you will, coming in and partnering up with very strong operators and folks that really understand how to give care. I mean, one of the sort of interesting things about the sector is it's not like just going to buy an apartment building that's got a distribution of population. In this case, you actually have a standard of care and responsibility for a bunch of elderly people. And so there's a real social problem that came out of that lack of expertise in operations the last time around that resulted in, a bunch of defaults. But what we're seeing this time around is far more measured and more institutional.
Right.
Which is good from a lending perspective.
Right, definitely, yeah. So you're looking for, right? Another question here from Scott Baker. Will the residence to office ratio change in favor of the former due to work from home? How much can this change before people don't want to bother living in expensive urban environments anymore?
I'm not sure I understand that question exactly.
Repeat the first part of it. The urban environment part. I think people are going to want to live in urban environments, and will this moderate the price? It's history has shown that these cities will all regentrify, repopulate over time. It's more fun to live. Generally, it's more fun to live in more urban environments, and that changes throughout the cycle of your life. But cities are not going away.
Thank you. We're going to get to a few more questions here. So this is one that was submitted before the webinar. Best equity source for portfolio purchase of multi-tenant infill properties.
Best equity source for
portfolio purchases of multi-tenant infill properties.
Is the question about what the best equity source is for that?
Yes, the best equity source, Warren, yeah.
I mean, there's so much capital in the system today. I mean, that profile is going to be chased by most of the, institutional owners and buyers. And it just depends on how much transition there is, whether or not it's really an opportunistic purchase or whether it's core or core plus. And the good news for someone who has a portfolio like that is there's a very, very deep bench for all those categories today, whether it's institutional money, high net worth money. And we're seeing a tremendous amount of high net worth money because folks have just gotten really rich over the last 18 months, those that were invested. I mean, if you were invested in the stock market and you're up 50%, I mean, that's a real increase in your net worth and liquidity and your ability to go out and invest. So we're seeing the high net worth channels being very aggressive on the acquisitions of assets like that too, with a perspective that isn't a 2 to 3 or 5 year horizon. It's a perspective that they want to own the assets for a long period of time. So if you do have that portfolio, it would be, I would imagine you're going to be surprised to the upside on what people are willing to pay for a portfolio like that.
Excellent. Next question. Which foreign countries are the most active in the US right now, I guess from an investment standpoint?
I mean, I can't pinpoint it exactly. I don't have the data to back it up. But as I said earlier in my comments, the dollar has weakened. Hedging costs are way lower. So countries like Korea are very active. Their hedging costs are down like 250 basis points in the last 2 years. So, if it was costing them 250 basis points a year to hedge their position just on the currency, well, that all adds to yield today. So, and there's plenty of capital sitting in that market looking to invest here.
I think that I was going to say the other thing is that capital is generally accessing the U.S. through fund investments right now because a lot of them are. I mean, the one thing we're seeing on the capital side is a lot of investors can't travel, won't travel, can't do due diligence. So what's happening is capital's flowing into funds with people that they've invested with before. And that you're seeing capital flow to managers who are big managers. So it's, there's a lot of money flowing in. The funds have been big, and capital is going to people that already have it because of the diligence issues associated with coming to the U.S.
Absolutely. We're also seeing a lot of family office activity in our reporting as well. There seems to be a lot of, very active family offices right now. Another question, what will it take for big multi-use projects to be funded again?
Not much. There's so much liquidity in the system. I think they're going to be funded.
Yeah, we've seen quite a few really huge deals happening. So I guess it's a good thing for the market, right?
Yeah, it depends on the use, right? You have to be able to underwrite it. It's the market, the use, it's everything.
Sure.
Real estate's always deal dependent, but I don't think you're going to see group hotels being built anytime in the near future. But you'll see leisure. I mean, there's so much money in the space. In every sector, there's money that's ready to get deployed. So it's really about the right deal.
Yep, absolutely. And last question we have from the audience, where are rates going?
No, it's an interesting topic, I mean, there's a lot of, let's see what happens here. But, I would tell you that both Chris and I expected rates to go up for our entire careers. And if you look at the last 20 years, rates have only gone down. So, look, I think there's a few things that we wrestle with on this front. I mean, the Fed intervention, it's become a thesis that a lot of people, including us, believe in, that the Fed is just going to step in whenever it needs to. Higher rates for the Fed represent a few limiting factors. One is debt service for the country is going up on a base of debt that the US has that is bigger than it's ever been. So it's got to still pay debt service on this debt. So a rising rate environment will result in more debt service, which will result in lower productivity or lack of productivity for the US. The second point is that a rise in rates is generally a monetary mechanism for the Fed to reduce issues associated with inflation. So I think that sitting here looking at the world and trying to figure out this inflation question is what one has to answer before you can really get to the rate issue. Because absent inflation, I think the Fed just keeps rates where they are, keeps rates really low. But if we do start getting a strengthening of inflation, not just in core inflation numbers, which are right around 5% now, but try buy anything today, anything, doesn't matter what it is, whether it's my tequila or whether it's another singlet for Chris because he likes to wrestle. You can't access any of the stuff. You can't buy tennis shoes.
So Warren, so why are you saying if there's inflation? I'm not sure that there's plenty of inflation. I think, do you want the government to actually recognize it, or do you want it to happen? Because what you're saying is that there's tons of inflation.
Yeah, so, the government doesn't really, I mean, the formula that they put out as the inflation numbers, I don't think represents the true inflation in the system. Okay. Now you have, the thing that moderates inflation is technology, and technology is becoming more and more, it's permeating the system more and more. And what it does is, because it does make the production of hard goods and other things more efficient, it is actually lowering the actual inflation numbers. But for all of us, we think there's more inflation in the system than is being reflected through the Fed's formula. So what does that mean? It means that if we're really thinking about what it costs for us to buy tennis shoes or whatever it might be, one would lead to say that we're going to get way more inflation than is being reflected. And then how does the Fed moderate that? Well, the Fed will moderate that through rising rates. So, I mean, I would imagine that rates are going to rise. Not out of control, but rates will rise over the next 2 years. And it really is something to keep an eye on, is this debate over whether or not the Fed's reflection of inflation is truly what the underlying inflation in the market is. And I think that remains to be seen.
Got it. It's really interesting. Now, we only have a minute or two left, but I'd love to know, how is your fourth quarter pipeline looking? What can we expect from ACOR?
Our pipeline is strong. I mean, we do correlate fairly highly to the investment sales market. And if you take a look at the RCA data that came out for the second quarter, we're up substantially in terms of investment sales. So we're back to, second quarter 2019 in terms of velocity in absolute dollars. And that's terrific. So our pipeline is very heavy, and which we like. And I don't think that this is going to abate at all. And it's not going to abate for a couple of reasons. One is I referenced 360 billion of private equity money sitting out there. We talked about the non-traded REITs with sort of $40 billion of investment capacity for this year, and on and on and on. And there is this idea that if we do go into an inflationary environment, that CRE is an incredibly great place to be because it's a great inflation-adjusted vehicle. So I don't see the investment sales market abating. I see it accelerating. And for us, we're also seeing more regulation in the banking market, notwithstanding the fact that they're underallocated from a loan perspective. So I think from our perspective, for Acor, I think that we are going to see more and more opportunity over the next 12 months. And I think our business is just going to expand.
Yeah, I think that the last thing I'd throw in there is I think with the potential for capital gains taxes changing next year, you're going to have more than a handful of trades that people try to get done before year end. So I'm expecting the next month to accelerate a handful of transactions that want to close by year end.
Interesting. And Warren, just touch quickly. So do you expect next year to be a far more conservative year for the banks in terms of the scaling back of the regulation, or how dramatic do you expect that shift to be?
In talking to a couple of my friends in the banking system, I think the absolute dollars of investment will grow, but they are facing more stringent regulatory environments. And
absolutely.
That's just their bailiwick. So they have this contrary thing, which is they have more capital they need to invest, and they're facing a tougher regulatory environment. So how they navigate that, not exactly sure. But the greater the regulatory environment, the more borrowers will come to the debt funds and folks like Acor to finance them. Right.
Absolutely. Well, that's us out of time, but thank you both so much for your time today. It was a pleasure, and we discussed so much more than I even expected. So hopefully I can see you soon for tequila or something like that, now that I know that this is your thing, Warren. So but it was an absolute pleasure.
Wait, you knew that, Kathy. Don't lie. You knew you did not learn that today.
I'm just kidding. But it's always a pleasure to chat with you guys, and hopefully I'll see you really soon in person because I miss seeing you. So
all right, thanks for having us on. We appreciate it.
Thank you so much. Take care. And thank you everybody for watching. Tune into the next one if you can. Take care.